Welcome to Talking Business, a podcast in Melbourne, Australia. The podcast is available on the Acast app, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 3 in our series for 2022, and today's date is Friday, February the 18th. Today, I'll be talking to Brisbane-based prestige property buyers agent Lauren Moore. Lauren is an advocate for buyers who she felt were underrepresented in Brisbane, and despite buyers agents being quite a new service in Queensland, she saw a gap in the market and decided to go for it. And I'll be talking to CommSec Chief Economist Craig James about what's ahead in the market for the week. But now let's talk to Lauren Moore.
Well, Lauren, you set yourself up as a sales agent in real estate, and that's really changed everything. Tell us about it.
Yeah, well, originally I was in sales back in the day. Probably when I started in 2020, I was in the sales role. Now I've flipped the switch and I'm representing buyers in the real estate transaction.
So as a buyer's agent?
A buyer's agent, yes.
Okay. So how's that different from what was before?
Well, the difference is there was a lot of buyers in the marketplace who needed representation, and the real estate agents have always somewhat controlled the narrative in regards to how properties are sold and purchased. And so buyers never really had the best representation out there because real estate agents aren't there to work for the buyers, they're there to work for the seller. So they're there to get the best price for the seller in the market. And what I found with local purchasers in my marketplace was that there was an increasing frustration because they were missing out on properties. There was so much competition that they were getting driven up in price dramatically and they were overpaying for properties or just missing out when making significant offers on properties. So I really saw it as an opportunity to come in and represent the buyer and actually give them some sort of equal playing field.
And you're based in Brisbane, aren't you?
I am based in Brisbane, yes. I'm based in inner city Brisbane.
Right. So are you just working in that inner city area?
I work sort of the inner north. So New Farm, Ascot, Clayfield, Wilston, Windsor, Paddington, Barden. And I have another girl who works with me, Jill, and she works on the south side of Brisbane. So she does Yeronga, Tarragindi. She also does Chelmer, Graceville. So basically we do the more prestige suburbs in Brisbane.
This is where there is a fair bit of liquidity and people are actually looking for property. And the property have some value.
Exactly. And Brisbane's market currently is there's limited stock. There's huge buyer demand. And even in the last couple of weeks, I've seen a massive increase from expats wanting to come home after the whole COVID thing. They're setting themselves up for, if something happens again, having a property here so that they can easily transition. And also I've had numerous calls from interstate buyers who are now really, really focusing on moving up to Brisbane. But another interesting thing that I've also seen in our marketplace is that a lot of local buyers in Brisbane are actually moving to the Sunshine Coast. so we have expats and interstate people trying to move up to Queensland, and then some Queenslanders are moving for a sea change. So it's been really interesting.
So how's the business been going since you set it up? And when did you set it up? And how's it been going since that time?
Yeah, I set up the buyer's agency in 2018, probably in March 2018. And I must admit my business hit the ground running, and I probably didn't expect it. I probably wasn't set up for it. And it was something that just organically happened. As I said, it probably made sense for me to go back into the real estate sales component of the industry. However, just with local frustrations, I realized that the buyers really needed representation. And so when I launched the business, I just had an influx of clients immediately. So probably within the first 2 months, I was at capacity of my client list, and it has just continued since then. And it wasn't a matter of hugely advertising my business or putting it out there. It was really just being part of a local community that really got behind me and rallied. And, there was huge referral business. And of course I profiled on social media and things like that. But it was only this year when Jill started that I actually started advertising a little bit in regards to my business.
Well, the issue is that the real estate industry has been hit pretty hard by COVID-19. What sort of impact has that had on your business?
Well, look, I haven't actually had a huge impact on my business. And once again, being in Brisbane inner city market, the buyer demand is just insane. What I did see was buyers who had larger properties to sell, or some buyers who were a little bit insecure about job security. They dropped off my client list, but typically buyers who still needed to buy, so people who were renting or people who were upgrading because potentially they had another baby on the way or things like that, or who had already committed to selling prior to COVID, I still had them as clients. So realistically, we had a great quarter coming through COVID, which was not expected. We didn't expect to. And then also coming out of COVID, we've rebounded really well. And I know this isn't necessarily the case for every market in Australia, but Brisbane currently is really performing quite well. Whether or not that will stay the course of time come September when stimulus packages drop off and things like that, who knows? It's a crystal ball sort of scenario, but I'd imagine that a lot more property is going to come on the market towards the end of the year and early next year. And that may be when our business drops off a little bit. But currently, because there's no stock in the market, we're really busy.
Well, one of the issues too is you've got rising unemployment, and that will affect the market surely with fewer buyers coming in. Yeah,
100%.
And so are you prepared for that?
Yes, I am going extremely hard on my business right now while our market is still strong. And I am definitely trying to save for a rainy day. But while it's good, I'm just going to continue on going.
It's interesting that you're focusing on Brisbane. Are you looking at other markets as well? I mean, you said the Sunshine Coast, Gold Coast could be another one.
Yeah, again, Sunshine Coast and Gold Coast are performing extremely well. Typically, when our markets do go in Queensland, the coasts are the ones that go first. But currently, we're seeing record prices throughout all of Queensland at the moment. Recently, there was a massive prestige sale in Brisbane of 13 million. And the market is still performing quite well. I don't expect that to continue, but, once again, I'm hopeful. But yeah, both the coast markets are performing relatively well as well. I mean, of course, there's pockets in Brisbane, which typically we don't deal in, the outer suburbs that are going to get affected a little bit more, especially with unemployment and also the stimulus packages dropping off. So it's not all sunshine and rainbows, but currently our prestige market is holding.
That's interesting. I mean, have you looked at other interstate as well?
Yeah, I mean, I know Sydney dropped off a little bit. I know Melbourne dropped off a little bit, but as I said, while the market is good here, I'm just running and trying to make money. So I haven't been paying a huge amount of attention to other states. All I know is it's time here for us right now, and the market's good, and we've just got to get in and do what we can.
Although potentially, if it continues and if the other markets do pick up, you could be looking at expanding.
Yeah, I mean, it would be fantastic. I mean, last week I did 3 deals, so I've been very busy here. And look, if it continues this way, Jill's been an amazing asset to our business, and she's doing an amazing job on the south side of Brisbane and the inner west. So if we get to that stage, I'd definitely be looking at bringing on more people.
That's pretty good. And it's quite a unique niche, isn't it?
It is 100%. And the other thing with buyers agencies is it is a unique niche, but there's not a huge amount of buyers agents that have a long industry experience. Typically, I guess the buyers agencies that are performing really well and are doing well, they're industry professionals. There tend to be a lot more buyers agents coming out into the industry now who don't have experience, and they're making the industry a little bit tricky. They're being pumped out. They haven't had real estate experience, and they're just coming into the market. They're charging smaller fees, and they're claiming that they're a buyers agent when really, unless you've got industry experience, they probably shouldn't be working in this space.
Well, it'll be fascinating to watch, and Lauren will watch it with great interest and fantastic news, and looking forward to talking to you again. Thank you very much.
Yeah, great. Thank you.
And now let's talk to CommSec Chief Economist Craig James.
Well, Craig, what can we expect from the market for the week starting the 17th?
Well, I think if we're looking at the economic data, I think the major focus will be on wages. The wage price index is coming out on Wednesday, and that's seen as somewhat the preeminent source of wage information here in Australia. Now, I suppose what we should say is that was always considered to be the preeminent source of wage data in Australia. The Reserve Bank Governor has poured a bit of cold water on it recently, saying that when he's looking at wage increases, he'll be looking at comments on wages received by the Reserve Bank Business Liaison process, as well as things like unit labour costs that come out of the economic growth equation, the National Accounts or GDP figures. But certainly it comes around once a quarter. It does provide sort of good indication about where wages are going. Now, the Commonwealth Bank Group, our economists believe that wages rose by 0.8% in the December quarter, and that was 2.5% over the year. Now, 2.5% doesn't sound a lot, particularly when you have a look at the rate of inflation. The headline rate of inflation is at 3.5%, and trim means at 2.6%. So it doesn't sound a whole lot, but it would actually be the highest level in 7 years. And we do know that when the Reserve Bank is looking at interest rates at the moment, it's looking very closely at three major measures: inflation, jobs, and wages. We know that inflation is on the rise at the moment and headed towards 3% for the underlying rate, the trim mean. The job market, is tight. The last part of the equation is wages. And now if we start to get some solid reading on wages, some of the economists around town will start bringing forward their expectations in terms of rate hikes. We've already had so quite a number who were looking at 2023 or 2024 now saying, no, it's going to be this year, 2022, and could happen as early as May or June.
May or June. That's quite extraordinary. And so what? And how many rate rises can we expect in that case?
Well, I think when they start lifting interest rates, there will be a process. So starting probably the current cash rate is 0.1%. I think the first interest rate hike will be just 0.15% or 15 basis points. That'll take the rate up to 0.25%. And then we'll start to march in 0.25% increments. And I think over a period of 12 to 18 months, we could start to be sort of seeing rates move up to, say, 1.25%. So I think households in Australia are prepared for it. There's certainly a significant amount of savings in place. People have got their buffers. People are paying off more than they need to. But when the interest rates start rising, certainly sort of people will be on guard.
Obviously, in terms of interest rate rises, I mean, you're expecting to peak at 1.25%?
Yeah, I think that's where they move to. They move towards what is a more neutral rate. And once you get to that sort of level, then you can start to determine from there whether you move into a tightening phase or not. At the moment, we're running extraordinary loose monetary policy, and that will still be the case when interest rates are rising. So we do have to see rates rise by a fair bit more before we can say that it's not slowing the economy down significantly or it's not speeding it up. But it will be certainly a point of adjustment for people who are paying off their home loans, as well as an adjustment for investors either in the share market or any other asset market.
The $64 question, of course, is how will this affect property prices? I noticed NAB last week was talking about it affecting property prices going down 10% next year, and Westpac has been talking about it going down 14%. What's your view about that?
Well, we think we'll see home prices peak when we start to see interest rates starting to rise. So we are starting to see early signs of a slowdown in the city markets. Brisbane and Adelaide are probably the strongest at the moment, along with Hobart. And they'll hold up for a little bit longer. But once interest rates start to rise, I think we will start to see a peaking in terms of the annual growth rate of home prices. Now, we'll probably get more modest growth in home prices for this year, still be recording something like, sort of perhaps 5, 6 or 7% annual growth this year. But next year we could see declines of around about 5, 6 or 7% as interest rates rise. So certainly not going down at the same sort of rate that they went up, but a correction to be in line with the fact that interest rates are rising.
Now, the issue is, so how long do you see this interest rate cycle going for?
Well, I suppose we've got to begin the cycle first. What the Reserve Bank wants to see is evidence that inflation is going to be maintained in the 2 to 3% target band. So there's a lot of uncertainties for analysts out there as well as for the Reserve Bank. At the moment, we know that inflation has been rising because of supply chain type issues. We've got a headline rate of inflation at 3.5% here in Australia, but it's not 7%. It's not 6 or 7% that we're seeing in other parts of the world. So we've still got relatively contained inflation, and if we see some of these supply chain difficulties start to dissipate, we see that the annual rate of inflation moves down a bit, so towards the 2.5% band. So again, the Reserve Bank might be a little bit more cautious. So what the Reserve Bank is waiting for, and want to see confirmation that prices are rising. Then they want to see the fact that wages are going to be rising. It's anywhere between a 3 and 3.5% annual rate. Now, even with the coming week, the expectation that wages will rise, we're still forecasting the annual growth rate only at 2.5%. So they're still short of what is probably the holy grail, 3% annual growth in terms of wages. So there's still a fair bit of uncertainties to be able to work through. Is the job market going to stay tight with the borders reopening and more migrants coming through? Inflation, will it continue to rise, or will the supply chain difficulties end? And wages very much in focus at the moment. Is the tight job market going to continue? Is it going to push up wages? And does that justify higher interest rates? So a few things still to play out.
So, I mean, while there is an expectation that the unemployment figure will soon have a 3 in front of it, we don't know how long that will last with borders being reopened.
Well, yeah, there are a degree of uncertainties out there. That's what the Reserve Bank governors are focused on. So we're going to be looking at inflation, jobs and wages, very much the case. But as is always the case, we're going to be looking at activity indicators as well. There's a lot happening at the moment, and we've just got to be on guard to see what that means, particularly in terms of the business sense. If inflation is rising and businesses haven't got the ability to be able to pass it on, that affects their profitability, and that affects their ability to be able to hire workers. In the coming week, watch for things like construction work done, which comes out on Wednesday as well. It gives an idea of activity in the building sector. We've got business investment figures coming out on Thursday as well. The investment expectations are rising quite significantly. They're up almost 20% over the past year. So if business investment looks as though it's going to continue to rise significantly over the next year, that will underpin growth in the economy, underpin things like inflation, underpin things like demand for jobs and wages. So watch out for that one in the coming week also. And it's not only the wage price index that we've got coming out on Wednesday. On Thursday, we've got another measure of wages, average weekly earnings. Now, that's running at a much slower growth rate at the moment than the wage price index. It's sitting around about 1.5%. But in the current environment, all things wages are very much focused on at the moment. It's not just the wage price index, but it's things like the average weekly earnings, unit labour cost, and the Reserve Bank indications, their business liaison process, and see what comments are being received by businesses about what's happening at the wage level.
Now, you're saying wages will probably peak at about 2.5%. I mean, that's better than what it was. But when was the last time wages were up that high?
Well, it was 7 years ago when we saw the wage price index sitting at 2.5%. But we've got to remember, if we go back, sort of 10, 12, 15 years, that it was quite regular to see wages growing anything between 3 and 4%. We haven't seen that for quite some time. In fact, it was only a couple of quarters ago that we were down at record lows in terms of wage growth, around about 1.5%. So 2.5% is what we're thinking in terms of wage price index in the coming week for the December quarter figures. But where the Reserve Bank wants to see wages is back where they were, as I said, sort of decade, 12, 15 years ago, somewhere around about 3%, 3.5%. And then they believe that employees are getting an adequate compensation in terms of their effort.
And that would affect the Reserve Bank's decision on hiking rates.
Certainly, yes. The wages is very much a driving element at the moment, together with the job market, the unemployment rate, as well as inflation.
Now, the other interesting thing is you talked about inflation before and that affecting costs. I've noticed with this latest profit reporting season, while the profits are coming in, I've noticed costs have been increasing and companies are reporting that. Have you noticed that?
Well, yes, and I suppose you're either in two camps. Sort of if you're a business, if you're in a business that's got a degree of pricing power that you can pass on the cost, then it's not so bad. Your revenues are rising, and your costs are rising at the same rate. But if you're in a situation where you've got very strong competition between players, you may not have the ability to be able to lift your prices willy-nilly. You may be looking closely at your opposition to see what's happening. So I think what every business is trying to do at the moment is they recognise that there's price pressures there, prices are going up, and they want to maintain their costs. So there's very much a close watch on expenses or costs in the current environment by business.
Well, that's quite extraordinary. So we'll be watching the wages figures very, very closely. And that will give us a guide on to where the Reserve Bank will be heading.
Yeah, certainly.
Well, Craig, thank you very much for your time.
Not a problem at all. Thank you.
So what's happening in the news? Well, Australian motorists may soon have to dig a little deeper to pay for their fuel after global prices rose to fresh 70-year highs amid mounting worries about a Russian invasion of Ukraine. Oil prices rose more than 2% overnight, with benchmark indices near the symbolic US $100 a barrel mark. Brent crude, for instance, rose 2.2% to US $96.48 in US trading. Australia's retail petrol prices are already at record levels, averaging 176.9 cents a litre in the week to 13th of February, according to the Australian Institute of Petroleum. Peter Cooley, the head of media at NRMA in New South Wales, expects average prices to rise to 180 cents a litre or higher in coming days, noting Brisbane prices had already reached 192 cents for unleaded. And Australia's biggest bank, the Commonwealth Bank, has brought its rate hike predictions forward from August this year to June. CBA now believes the Reserve Bank of Australia will hike rates by 0.15% in June, followed by 3 more 0.25% increases to finish the year, with a 1% cash rate. CBA's head of Australian economics, Gareth Aird, said CBA also expected another hike in the first 3 months of next year to bring the rate to 1.25%. And the Australian National Audit Office has criticised the management of a federal grants program used to improve community safety, finding it favours government-held seats, and that decisions are often made without clear and recorded justifications. Peter Dutton was identified as a minister who approved 2 grants in 2018 which did not meet selection criteria. An assistant minister was also found in the audit to award 5 applicants a total of $1.3 million for applications which did not meet the criteria. The $184 million Safer Communities Fund was established in 2016 to address crime and antisocial behaviour by providing schools or at-risk organisations with money for more security cameras or streetlights. The ANAO found almost 60% of all projects funded since 2016 have been in coalition-held electorates, compared to 27% in Labor electorates. And Australia Post has defended paying its top executives bonuses, averaging more than $160,000, with Chief Executive Lucio Di Bartolomeo saying the payments were part of employees' remuneration packages. Under question from Labor in Senate estimates over average top-up payments of $168,000 for employees earning between $300,000 and $400,000 a year, certainly worth more than a few Cartier watches. Mr. Bartolomeo responded, "We certainly don't see them as bonuses at all." Tasmanian Labor Senator Anne Urquhart said the rise in some employees' bonuses was 6 times the rate of inflation. Mr. Bartolomeo said this was because performance varied year to year, and those with such an increase in pay had simply performed very well. He said the incentive payments were independently benchmarked against other industries, and the remuneration was set to attract quality people to the organisation. And Treasurer Josh Frydenberg has made clear the federal government's low and middle income tax offset is not a permanent part of the income tax system, giving him scope to push back on pressure from the coalition ranks to offer a pre-election sweetener to millions of voters in the budget. As Labor signalled it would not press to extend the offset itself ahead of the looming election and domestic petrol prices pushed all-time highs, Mr. Frydenberg likened the tax refund to stimulus measures needed to support the economy through the COVID-19 recession. More than 10 million people received the offset, which is worth $1,080 a year, and has been extended to the last 2 budgets as stimulus to support the economy through the coronavirus recession. The economy has recovered much more quickly from the recession than expected. And supply shortages have hit super funds. According to estimates from leading superannuation research house Super Ratings, the median ballast option returned minus 2.1% in January following the market sell-off, despite some of the initial losses being recovered towards the end of the month, reducing the negative impact. The supply shortages have seen the price of goods and services such as food, automotive, fuel and healthcare bearing the brunt of the impact. And house prices will fall 14% over 2023 and 24 as strong inflation forces the Reserve Bank of Australia to start lifting interest rates from August this year, according to Westpac. After notching up 22% growth last year, spurred by the record low of 0.1% cash rate, national house prices will eke out just 2% growth in 2022 as early gains are offset towards the end of the year. And James Packer is set to become $3.26 billion richer after Crown Resorts accepted an offer to sell its entire Australian casino empire to a US private equity firm. Crown Resorts has accepted an $8.9 billion takeover offer from the world's largest private equity firm, Blackstone. Under the terms of the offer, Crown shareholders will receive $13.10 a share at a 32% premium to Crown's closing price on November the 18th, 2021, when the offer was first made. The Crown Board has unanimously recommended shareholders vote in favour of the transaction. The $8.9 billion Valentine's Day engagement between casino giant Crown Resort and markets giant Blackstone comes after the end of a period of deal-making that has been at times exhausting, exhilarating and excruciating for all the parties involved. If shareholders and state-based gambling regulators approve the deal, Crown Resorts will be delisted, with Blackstone taking control of the flagship Melbourne South Bank complex, its Perth property, and the $2.3 billion hotel and casino tower at Sydney's Barangaroo. Some observers have expressed concern over Crown falling into the hands of private equity, which does not face the scrutiny of a publicly listed company. Packer's hand was effectively forced given last year's Victorian Royal Commission, which recommended cutting his stake in Crown from 37% to less than 5%, which the state government accepted along with all the other recommendations. The New South Wales government also backed all suggestions stemming from its explosive 2020 inquiry, including limiting stakes in a casino licensee to 10% unless approved by a new powerful independent casino commission. Both recommendations came after Mr Packer's influence on Crown was labelled disastrous by the New South Wales investigation, as he was the driving force to secure more of the Chinese high roll of junket tours at the centre of the gaming giant's money laundering scandal. Mr Packer has been steadily retreating from public corporate life, stepping down as Crown's chairman in 2015, quitting the board in 2018, and then trying to sell a 19.9% interest in the company to Hong Kong gambling giant Melco Resorts, an ill-fated transaction that only got halfway through when the New South Wales inquiry was launched. Mr Packer's shareholding is worth about $3.2 billion and represents his last major financial link to Australia. The Packer family has been a major shareholder of Crown and its forerunner, Publishing and Broadcasting Limited, since the mid-1990s. Though Mr Packer once hoped to make Crown a luxury brand spanning casinos in Australia, Macau and the United States, the regulatory scrutiny caused by the group's misconduct led to him ending his involvement in Crown's affairs. And former New South Wales Premier Gladys Berejiklian has been appointed Optus's new Managing Director of Enterprise, Business and Institutional, as the telco looks to take a greater share of the enterprise market. Berejiklian, who resigned from politics after the state's anti-corruption watchdog revealed it was investigating her over a potential breach of public trust last year, will take up the newly created role on February the 28th. The role will focus on unlocking a greater share of the multi-billion-dollar enterprise business and institutional markets, Optus said. Berejiklian spent almost 5 years in office, becoming Premier in January 2017, after serving as Treasurer in the Baird government and Transport Minister in the O'Farrell government. She also worked for the Commonwealth Bank prior to being elected as a member for Willoughby in 2003. And Libby Chaplin heads up the new battery recycling scheme, B-Cycle. B-Cycle will initially cover the smaller alkaline and lithium batteries that come inside common household items like television remotes and power tools. It has teamed up with major retailers including Woolworths, Coles, Bunnings, Officeworks and Aldi to put battery collection bins at thousands of their stores. And it's a profit reporting season. Fortescue reported underlying EBITDA of US $4.8 billion for the 6 months ending 31st of December. BHP's revenue from continuing operations rose 27% to US $30.5 billion, while profits soared 144% to US $9.44 billion. Cardinale Property Trust reported statutory profit of $14.1 million for the half year to December 31. Its funds from operations rose 16.6% to $12.9 million. GWA Group's revenue rose 2.1% to $201.3 million, while EBIT firmed 1% to $30.2 million. Net profit rose 0.3% to $18.6 million. Sims reported a 73.9% increase in sales revenue from the prior corresponding period, with an EBIT of $361.7 million in half year 2022, 541.3% higher than the previous year. Adore Beauty's interim revenue increased 18% to a record at $113.1 million, and the EBITDA margin came in at 3.3%. Personal and auto lender Money3 has reported net profit up 29.6% to $25.8 million on income, up 34.5% to $91.4 million for the 6 months to December 31st, 2021. Beach Petroleum grew net profits after tax 66% to $212.9 million for the 6 months to the end of December from the same period in the prior year, following a surge in the price of oil. Boral reported sales revenue from continuing operations of $1.5 billion for the half, up 1%, while EBIT, excluding property, was down 23% to $78 million. Premium reported EBITDA for the half of $7.5 million, up 6%. JB Hi-Fi's revenue slid 1.6% to $4.9 billion, while net profit fell 9.4% to $287.9 million. Horizon's revenue rose 1% to $1.5 billion, while EBITDA fell 2% to $726.9 million. Net profit slid 4% to $256.9 million. Audinate reported a 33.3% increase in revenue for the half year ending December 31st to US $14.8 million. That's 20.2 million Aussie, while gross profit increased 30.2% to US $11.2 million. Key Path Education confirmed it will hit its prospectus forecast for the 2022 financial year after reporting first half revenue of US $56.9 million and a net loss of US $13.5 million. Carsale.com revenues rose 21.6% to $241.9 million, while profit for the half year climbed 22.3% to $74.9 million. Bendigo and Adelaide Bank's revenue climbed 8.5% to $965.1 million, and net profit rose 31.7% to $321.3 million. Sky City's revenue fell 35.6% to New Zealand $89.8 million, that's 270 million Aussie, and net profit slid 143.3% to a New Zealand $33.7 million loss. Diversified property giant GPT Group turned in a $1.42 billion annual profit. Tech company Reckon posted a 7.8% increase in net profit after tax of $7.9 million on the prior corresponding period. EBITDA was $29.5 million, up 1.4%, driven by cloud-based products. Revenues increased 1.6% to $71.3 million, with subscription-based revenues accounting for $65.3 million. Ansell's sales rose 7.6% to $1.01 billion, but EBIT fell by 24.3% to $111 million. Seven West's revenue from ordinary activities rose 27% to $818.4 million, while net profit firmed 3.2% to $120.5 million. Group EBITDA was up 30.5% to $215.3 million. Atomos reported first half revenue of $40.9 million, a record interim result, and up 25%. Elmo Software reported group annualised recurring revenue at the end of the first half of $98.3 million. Property group Dexus increased net profit after tax by 82% half year 2022 to $803.2 million. SEEK's sales revenues from continuing operations rose 59% to $517.2 million, while reported profit from continuing operations was up 152% to $126.7 million. Total reported profit rose 32% to $88.1 million. Lifestyle Communities reported an 83.4% jump in revenues to $93.9 million in the first half of 2022, with earnings before tax of $40 million, up $87.8 million. Net profit after tax rose 95% to $27.5 million. Tassal Group's revenue rose 43.3% to $419.1 million, while EBITDA climbed 14.1% to $89.5 million, and net profit firmed 10.3% to $31.2 million. EBOS Group reported revenue of $5.3 billion for the first half, up 12.8%, while its underlying net profit after tax climbed 15.8% to $109.3 million. Statutory net profit after tax was up 9.7% to $101.9 million. Fletcher Building reported revenue of $4.06 billion for the first half of financial year 2022, up 2% from the prior year, leading to a net profit after tax of $171 million, which is 41% higher than the prior year. Breville's revenue rose 23.6% to $878.7 million, while EBITDA firmed 16.6% to $125.5 million, and net profit advanced 25.1% to $77.7 million. Emeco's revenue climbed 16% the first half compared to the prior half to $373 million, while its operating EBITDA rose 2% to $122 million. CSL's revenue rose 5% to US $6.04 billion. However, profit slid 3% to $1.76 billion. On a constant currency basis, profit fell 5%. Prosper recorded record half-yearly origins of 315.1 million this half, up 75% on the prior corresponding period. SG Fleet's revenue rose 79.9 to $433.4 million. However, profit only rose 16.6% to $29.7 million. Treasury Wine's reported earnings before interest tax, SCARA and material items, EBITS, declined 7% to $262.4 million in the first half. Nearmap's revenue rose 23% to $67.6 million, while its net loss grew by 27% to $11.9 million. Vicinity Centres' revenue from ordinary activities fell 0.1% to $581.5 million in the 6 months to December 31, but the company reported a $650.2 million statutory net profit after tax for the period, a 265% improvement on the prior year's $394.1 million loss. Santos's revenue rose 39% to US $4.7 billion, while net profit soared 284% to US $658 million. Underlying profit climbed 230% to US $946 million. Redbubble reported first half revenue down 18% to $341.6 million, including artist revenue of $53.5 million, down 17%. Its net loss was $1 million from a profit of $41 million in the previous corresponding period. Software business ReadyTech has reported net profit up 336.2% to $5.8 million on sales, up 63.7% to $35.7 million for the half-year period to December 31st. EML Payments grew revenues by a fifth to $114.4 million in the 6 months to the end of December compared to the same period in the prior year, while earnings eased slightly. Earnings before interest, tax, depreciation and amortisation eased 4% to $26.9 million. Netwealth's revenues rose 17.1% to $84.7 million. However, net profit slid at 1.8% to $27.1 million. Aurora's underlying net profit after tax before significant items climbed 12.9% on the prior corresponding period to $102.7 million. Evolution Mining's revenue slid 9% to $898.6 million, while EBITDA dipped 24% to $393.3 million, and statutory net profit slid 60% to $90.8 million. Pact Group's statutory net loss after tax was $20.8 million compared to a statutory net profit after tax of $49.9 million in the previous corresponding period. Underlying net profit after tax for the period was $39.3 million compared to $52.1 million in the previous corresponding period. Revenue for Health Medicus rose 40.3% to $44.3 million, while net profit climbed 52.7% to $20.7 million. Corporate Travel Management reported a net loss of $8.6 million for the first half, narrowing from $36.4 million after revenue more than doubled to $158.1 million from $56.5 million. Hotel booking software company SiteMinder has entered a new chapter, turning the page on the travel industry's pandemic doldrums to record an 8.9% revenue jump to $55 million in the first half. While SiteMinder's revenue increased, so too did its statutory net loss for the 6 months to December 31. This hit $87 million thanks to a revaluation of derivatives on preference shares when it was still a private company. On an underlying basis, the company's net loss was $18.6 million as it continues to invest to accelerate growth. And that's it for this week. And next week I'll be talking to Jussi Karjalainen at Valtatech with his tips for business resiliency and future-proofing your procurement operations. And I'll be talking to Indeed economist Callum Pickering about the latest jobs figures. In the meantime, you can catch me on Facebook, Twitter, Instagram and LinkedIn. And if you want, leave a comment. Wishing you all a safe and healthy